Hi everyone, so let's talk about skewed short strangles and how I use them to profit. I think it's really important because specifically for me, I sell neutral positions, so basically just strangles for the most part, and things are not always aligning the exact same we want to. So using skewed strangles is definitely a pretty easy and cool way to get things exactly the way you want it to. So let me tell you exactly how a skewed triangle might be helping us, and also I will go through the actual interactive brokers here, and I'll show you exactly what I mean by skewed triangle. So just bear with me here. So for me to open a position, and let's say I'm just taking as an example crude oil, I would want to see what is the range to my stop losses. So I would go, let's say I'm going to sell the delta 21.9 on the put side, and then the delta 21.8 on the call side. And I just want to see what is my range to the stop losses. So currently we can get about 24.50. So let's round it up, $2,500 in credit. My stop loss will be about half of this, which is 12.50. So let's see at what price of crude oil I'm going to be down about 12.50. So it's 61.31 on the downside. So let's go and put it on the graph here. 61.31. So 61. There we go. And then I want to see my upper range, and I want to see exactly where is my stop loss, where approximated stop loss, I guess. It's never obviously exact science, but it's very good. And this is exactly what I would do. And here, if we put in the line, will be 74.22. So 74.22. So this is the range that we would have to the stop losses on the bottom and on the top. Now, as you can see, it's actually a pretty good range, pretty good. So this is actually a really classic situation on how I would use it. And you can see what I don't like is the price is cutting into here, and I would like maybe to move my put side a bit up, or the stop loss, to move the stop loss on my put side a bit up, and on the call side also a bit up, to have a better range for my stop losses. Ideally, so would be ideally, I would look for a stop loss something like this. This will be definitely an ideal stop loss, even though it's much closer on the put side, because the price of crude oil have been in this range basically since, what is it, June of 2023, right? I mean, this is what I would do specifically. Even in this case, I don't think we can really get it to that point, but we can definitely do something like this, where we raise the stop here and also raise it up on the put side as well, just enough for us to really have a nice range. And even this is a pretty good range. The price have been moving in this range since July of 2024. So we are 7-8 months of price movement within our stop losses, which is really good. Now, how would I do it? So usually, if you want to move everything from the bottom to the top, you would want to push your put side closer. So, or basically your put strike closer. So what we are going to do is, our put side is at 61. Let's try and move it from 61 to maybe 62 and a half. And maybe 76, because you do need to move the call side as well, just by one strike to 76 and a half. So let's go and see. So we have way more credit right now, obviously. So it's 2720. Let's call it just 2700. So it will be 1350 for the stop loss, and I'll just go and do the exact same thing. So 62.12, 62.12. So we already went up from 61.33 to 62.12. For the stop on the put side, and then over here it will be, again, I'm looking for a loss of $1,350 because our max return right now is 2,700. So again, just half of this is my stop loss. So 1350 will be right over here. So 75.35. So 75.35. Oh, that's a bit too much. but basically you got a point here. 75.30 was good enough, but you got a point here. So right now we just moved it just enough to give us a bit more room on the top, because again the price have been moving in the range, and I care about in what range the price have been moving within. This is really important, because if the price have been moving within this range for 8 months, it's likely to continue to be in this range for the next whatever 30 to 35 days, or even like 20 to 30 days, which is ideally all you need to be in a really good position to profit. And from there, it doesn't really matter if it kind of goes up or down, because your range is actually your stop losses are expanded so much just because time decay and your position is profiting. And also we have a bit of a delta profit here. So if the price goes up, you will be profiting just purely on delta, because this is kind of a directional position, because this is a skewed strangle. So this is how I would go about using a skewed strangle to make sure that my stops are where I want them to be. So in this case, this will be plenty good for me, to be quite honest. And obviously anything can happen, but I do it pretty much regularly, and it's been pretty good. And again, we're not trying to do something very extreme, where let's say if the price would have been over here, so let's see if we can replay and put the price like over here, and then we're trying to get this kind of stop, because now we have a really close proximity to the stop here on the bottom side, and on the top side we have quite a lot. So it becomes a pretty big directional position where you really need the price to move up, basically. But here right now it's not as aggressive to the bottom side, so we have some room on the bottom, and we have way more room on the top, just in case the price decides to explode up. And in my experience, usually if you have a range like this, the price tends to bounce always up and down. So we just tested the bottom side of the range, which is right here, and the price bounced back up. It might stay, it might go sideways, it might go a bit down. It doesn't matter. At the end of the day, it's all just neutral trading, and we were just trying to bet on the idea that the price would stay within a certain range for a certain amount of time, and that range is the stop losses for myself. And this is exactly how I would go to do it for myself. And it's been working and doing pretty much wonders, because sometimes you have all the good conditions to enter a position, but your stop losses are not equidistant, or they are equidistant, but they don't cover the correct range for the product that you want to trade. And then you can just kind of play with the strikes a little bit, and then you can get the exact range that you want without too much complications. And yeah, that's about it. I think this video is probably one of the shortest ones I've made, but really good, useful information. It's a really good, useful technique. I use it all the time, and yeah, I'm sure some people can find it pretty useful. Some people actually even use it, if they really want to place a directional trade, instead of just going a short call or short put. They will just enter a really skewed strangle, and what that does is actually gives them a lot of protection on one of the sides. And then obviously if the price doesn't go anywhere, they can still profit from both sides and time decay, which is a huge plus. But that's about it. Again, thank you so much for watching, and I will catch you in the next one.